Easing geopolitical tensions pushed oil prices lower. Yesterday, oil traded mixed with high volatility. Such dynamics in the commodity market can be attributed to the situation around Ukraine. Once it became clear that US President Joe Biden's claim of a Russian military invasion of Ukraine had not been confirmed, oil prices dropped to $92 from $96 per barrel. The fact that political news has taken a backseat cannot but rejoice. At the same time, do not forget that investors have enough other reasons to worry. Market participants are still concerned about moderate oil output increases, supplies, and the widening supply and demand gap. The risks are quite high. Oil continues to gain value, while the largest oil exporters remain silent. If the situation does not change dramatically, oil prices will have every chance of rising to $100 per barrel in the mid-term. Until then, it seems that Riyadh and Moscow are not going to take any action. However, their authorities have repeatedly declared that they would not allow excessively high oil prices. Despite local price swings, Brent crude oil futures are still in an uptrend. The level of $96.70 per barrel acts as resistance, while the $91 mark is seen as a variable pivot point. Given that market sentiment is still bullish, it can be assumed that consolidation above $96 per barrel will eventually push the price to a new local high. In the meantime, the market is experiencing a pullback. When political statements and risks take a backseat, technical signals become clearer. Yesterday, a decline in the value of the dollar to 75 from 77.50 rubles per dollar ended with a local rebound. As it should be, the main drivers of the foreign exchange market are currently macroeconomic indicators rather than news and speculators. The Russian currency is being supported by strong disparity in interest rates. In the medium term, the dollar-ruble pair may well return to the level of 74 rubles per dollar, but it is still too early to talk about such a movement. Traders continue to closely monitor developments around Russia and Ukraine. Thus, until the situation stabilizes, the risk of new speculative swings remains. From a technical point of view, the dollar versus ruble pair ended its downward inertial movement around 75 rubles per dollar with a rebound. Based on market cycles, we are witnessing a change in trading forces following strong price fluctuations. Given that speculative fever around the news still persists, new price spikes cannot be ruled out. In the meantime, the level of 76.50 rubles per dollar can be seen as an entry point for long positions and the 74.25 mark for short ones. Since the opening of the American trading session, the precious metal has gained significantly. Thus, gold prices have already approached the level of $1,880 per ounce. Such rapid growth can be attributed to the situation in the United States. The point is that the US Federal Reserve reiterated its intention to tighten monetary policy more seriously and raise interest rates in March. On these expectations, the major stock indices show progressive declines. Market participants continue to invest in safe haven assets, including gold. However, the asset has repeatedly proved its strong dependence on the Fed decisions. This means gold prices could edge lower in the future. In other words, their current rally is temporary. After a short-lived pullback, gold futures rushed up to the recent local high again. If the asset is able to stay firm above $1,880 on the 4-hour chart, it will head for the level of $1,900 per ounce. A strong signal of a continued uptrend will come only after the price consolidates above $1,920 on the daily chart. Until then, there is a risk of a rebound. Well, here is the forecast for Thursday. We hope this review will help you make your profit. Have a nice day and stay tuned.